Okay, another week has gone by. Hard to believe. Today is the 11th of April, 2024, and welcome to another WWM Talks. And I'm Steve Wolf, and I'm here with Vince Stefano and Greg Carroll. And we're going to talk a little bit about what's been happening in the markets and other things. Anything you guys want to start with?
Well, I'm going to start with this past week because everybody was talking about Fed and rate cuts, and all of a sudden we get a hot CPI number coming out, and I believe it was up 3.8% year over year. Well, the first thing that did, that sent the June interest rate cut down to about 23%. Larry Summers came out and said, "Hey, don't look so quickly because the Fed may actually have to raise rates as opposed to cutting them." So that kind of sent the market into a little bit of a funk. And right now, I think you're seeing a lot of the market looking at the Fed and not really understanding what they may do going forward. And I think it's causing a lot of volatility. And what we're seeing is that, companies are, the stock market is being hit a little bit on any type of rate hike information. So I'm going to leave it there. I have seen some pre-announcements from, companies, but they're lower quality companies. We do have, 5 really big financial companies reporting tomorrow on the 12th, and it'll be very interesting to see, what they say going forward. They may be cautious, Again, I think this Q1 earnings season is going to be a little more difficult than people anticipate.
It's funny because I get a lot of people telling me that they think, the economy is really doing okay, and the interest rates are coming down. And, why do people feel like it's not doing that well? Okay, but really what's happening is the idea that rates are coming down is true, but it's only part of the story, because it started at 0. And we went to about 9-something%, and we're still somewhere in that area of 3
You're
to 4.
referring to inflation, not interest rates.
No, I'm sorry, inflation
yes.
rates. Yes, that's correct. But that has a big, it determines where the yields are going.
Right.
But what's interesting is what I'm saying is that people don't feel that things are good. Okay, and I know from a political standpoint that may be not so good for who's in charge, but by the time the election comes, that may not be an example, or it may not be a problem. But when it goes from 0 to 9 and you're back to about 3.5 or 4, it's still up a lot from where it was at 0. And a lot of the things that are up: housing, food, gas, electricity. Those are the things.
Insurance.
Oh gosh, have you seen your car insurance bill lately?
Like 23% in the last 12 months.
Incredible.
That's unreal.
So the things that people buy every day, they go to the grocery store, and where it used to cost them $200 for a week's worth of groceries, now costing them $300. They don't care that the PCE rate, is down from 9 to 4. It doesn't matter to them.
Right. Yeah, I found it interesting. I was reading the other day that job growth since October of 2022 has basically been flat, except for government, healthcare, and leisure. And I think leisure is starting to slow down because a lot of that revenge spending and traveling and all of that is starting to subside a little bit. From what I understand, the government increases in jobs is a lot to do with all the immigration that we're trying to deal with. They got to hire a lot of people to deal with that all over the country, from border patrols to social workers, all of that. So I think, from what I understand, job growth could really start slowing down, which means unemployment could come up later in the year. And that's what the Fed's been talking about for over a year, is that they want unemployment to be about 4%, 4.1%, something like that. They can see that inflation will really start slowing down. Maybe that's when they finally lower rates.
Well, the COVID money dried up, and so you're right. There was a lot of money that, has now not fallen into the economy, and you're seeing it with some of the credit card companies now talking about how there are more defaults on credit cards, and late payments are rising dramatically. And another interesting. I was watching Fox Business the other day, and I saw a chart, and I wish I would have taken a picture of it. But small business optimism is now at its lowest level since 2012, and that kind of leads into what you're talking about, Greg, where small business is one of the biggest employers of people in the United States, and if they're feeling very, very conservative, they're not going to be hiring a lot of people.
Well, in this last report, government report, it said that jobs were plentiful. The thing is, though, where the growth of jobs occurred was in government. So the government is hiring. That's not really where you want the growth of jobs.
Exactly.
They're not the ones producing the money, the tax money, et cetera, that goes to support the government. So, I was looking at the yield curve, and I have a chart here that this was back, this is up today, but we know that yields have gone from almost zero to where they are today. And the 1 month Treasury is at 5.5%. The 2 month is at about 5.5%. Then it starts going down a little bit, gets to the 6 month where we're 5.4%. This is where we were just a few months ago. So those yields have gone all the way back to where they were. So any good thing that was happening because of any positive things that were happening because of lower rates isn't so much happening now. If you get out to the 10-year, it's lower. And again, we still have this inverted yield curve. My goodness. This is the longest I can ever remember, and I've been doing this for almost 40 years now. This is the longest I can ever remember that we've had an inverted yield curve and we didn't have some sort of recession.
Yeah, the average is 19 months before we have a recession. And I think we're at just a couple months past that. So we're on the clock that we could still have a recession potentially later this year.
All I know is I feel like we've been talking about a recession is going to happen for at least 2 years now.
It feels like that.
So then everybody said, well, we're going to have rates coming down. Everybody was saying we're going to be 7 rate cuts this year. Now we talked about we probably aren't going to have it, but we thought there might be some. Then they said 3 rate cuts. Now there's people saying maybe there won't be any rate cuts. So I guess the moral of the story is that try not to listen to everyone who's predicting anything, including us. So another thing that I was looking at was the CNN Fear and Greed Index, which is something I really like to look at because it's interesting. It's one of those things that if you do the opposite of the way it feels, you'll probably do okay. But right now we're almost squarely in neutral territory. A couple of months ago, not even, about a month and a half ago, we were almost in extreme greed. I think we were in extreme greed at about 90-something points, and this is from 0 to 100. And we're right now at 51 as of this morning. So we're right in the middle of that and not sure which way we're going to go. But certainly we're getting to be a little bit more fearful. You look at the markets have had a few bad days now. But interestingly, I don't know if people understand what is involved in the Fear and Greed Index, if you don't mind
I'm not familiar.
Indulging me with this. What goes into this, and this is the CNN Fear and Greed Index, they use stock price strength, stock price breadth, put and call options, market volatility, safe haven demand, and junk bond demand. And what they do is they look at all those things together and they come up with this Fear and Greed Index. And almost every time we're in extreme fear, if you had bought in the marketplace and you held on long enough, you would have done okay. With extreme greed, if you bought at that point, you probably were going to lose some money. So right now we're in the middle and not sure which way we're going to go just yet.
Yeah, you hear a lot about, bubbles, but, maybe more in like the Magnificent Seven or something. But I was surprised that you said that. It's right in the middle. I would have assumed it was higher.
Well, it was just a few weeks ago.
Oh, okay.
And maybe 2-3 weeks ago, we were still in the greed, but not extreme greed. We were probably, if I remember right, maybe about a month or 2 ago, we were in extreme greed, and now that's come back. And what that means basically is that, people are going to do anything to make money, But I've always said, and I think people agree with this, that fear is a stronger emotion than greed. And that is why when the markets go down, they go down much faster than they go up. The EV market is starting to slow down.
Completely.
You want to give some reasons why?
Well, part of it is, number one, they're too expensive. Number two, they can't get enough charging stations. Number three, if you're living in a very cold climate, you may not be able to start your EV if the temperatures drop below a certain point. And also, batteries are now catching fire more quickly than they anticipated. So you've got a lot of negatives on the EV side. And that's why I think more people are now looking at hybrids. And, you know,
Well, Toyota's been saying that for
Yeah.
a long time now, that they think that the hybrid does, for the climate change, it does almost the exact same thing as an EV does, because those hybrids have almost no emissions, that are bad.
Yeah, they're getting 50 miles to the gallon and stuff, so
Right.
it's much more, much better for the
well,
environment.
For the environment, and you don't have to worry about, am I going to find a place to charge my car? How long will I have to keep it there?
How cold is it outside?
I have a Toyota Avalon, and I am just amazed. Toyota Avalon's a pretty good-sized car. Big trunk, it fits 5 people easily. And I'm getting, on average, almost 40 miles to the gallon. I just took a trip to...
Is that a hybrid?
It is a hybrid.
Oh, okay.
And I just took a trip to Palm Springs, and I averaged almost 55 miles to a gallon with that car. And I'm thinking, that is fantastic. It's probably not as good as an EV, but I knew that there was a gas station around. And I also knew
I can do that when I go downhill for a long time.
with your car, you can get that much?
I think it gets that way.
That's what happens when you get those super sports cars.
That's true.
So,
But yeah, no, EVs are a difficult place right now, and a lot of investors have jumped into the EV charging stations, and they've lost money because they thought that the government was going to be building all these EV stations around the country. Unfortunately, they're not being built, and the companies have not done well. So again, I think that as you just said, Steve, the companies, big companies, car companies, are looking more to the hybrid space, and there's a good reason for it. When Ford loses $4.6 billion on EV sales, they're not going to continue to make EVs for a long time.
They're going to slow down.
Yeah, they're not going to do it.
I always wonder, how a company can lose that kind of money consistently. And I'm not just talking about Ford, any company. How they can lose that kind of money consistently and stay in business. That's always been a mystery.
Creative accounting.
Well, I have a feeling it's something more than that, but I don't know. You lose $5-6 billion in a year, and you're still able to
Billion here, billion there.
Yeah.
That's right.
There was a senator from Illinois, Senator Dirksen. He was the one that said when $1 million was a lot, $1 million here, $1 million there, pretty soon it ends up being a lot of money. Well, today it's $1 trillion here, $1 trillion there, and pretty soon it's a lot of money. So that's where we're at. Anything else going on that we should talk about?
No, although one thing I have seen is that, since we're coming into the earnings season, it's kind of interesting. Higher quality companies have been announcing a lot of dividend increases. And for those investors, especially older investors who are looking at dividend income, that's a good sign, because it means that these higher quality companies really have a lot of good, solid free cash flow, and they're returning that free cash to the investor. So, yeah, I think that's a really good sign going forward. Right now, again, there's a competition between bonds and stocks on the interest rate side, because you can get a pretty good rate with fixed income, but also companies now yielding 4 or 5%. People are going to start looking at it and see where the trade-off might be.
Well, some of those companies making 4 and 5%, or there's some of them that have got hit last year or so. Mm-hmm. And you almost have to look at the ones that are out of favor. Not that you shouldn't have the ones that are in favor, because a lot of those companies are great companies. But if you're looking to have a little bit more oomph, if you will, in your investment, you got to look at the stuff that really didn't do well over the last 2, 3, 4 years. Right now, AI is still where it's at. Anything to do with AI, you're still making money, but it definitely has slowed down. And you can see that and daily in the markets, what's going on with tech stocks. Yes, they're still doing well, but they're starting to lose some of that momentum, I think. You guys agree with that?
I do, yes, absolutely.
All right, well, let's end this week then on agreement, and we'll see everybody next week. Thanks a lot.
Bye.